Good morning. Thank you once again to everybody who's joined us today, both on YouTube as well as on Teams. I think what we wanted to actually discuss today is about the alternatives to debt fund. And I think this conversation has come out of the change in regulation and how debt funds are going to be taxed in the new financial year. So today, both Roshan and I will be going through what are some alternatives to debt funds, and we'll be evaluating these alternatives based on both safety as well as tax efficiency. And hopefully, this will give you an idea on what kind of framework you can use to make future decisions, as well as follow a more objective approach to evaluating things and looking at tax efficiency from a different perspective also. So this will be more of an interactive session. So if you have any questions, please do type them out in the chat box or in the Q&A section, and we'll be happy to answer them. Am I audible? I think there was a comment that says that you're not able to hear. All right. So then I would sort of proceed with this. Okay. So I think the start of all of this, like I mentioned, was the finance bill that changed the way taxed at 10%, pretty much like an equity instrument. So that has been changed to slab rate today. Similarly, debt funds as well as conservative funds, dynamic asset allocation funds, as well as multi-asset funds, depending on what their equity exposure is on average, would come under this taxation. Uh, for domestic equity exposure that's in the range of 35 to 65%, your short-term capital gains will be at your marginal tax rate. If you hold these investments beyond 3 years, then you will get indexation benefit, and the tax rate at that point is 20%. And the category that this really applies to is balanced hybrid funds. And if you have more than 65% equity exposure, then your short-term capital gains is at 15% without indexation. Your long-term status, it takes 1 year to achieve this, and you don't get any indexation benefit, but the tax rate is going to be 10%. So within this category, pretty much all domestic equity funds, equity savings funds, as well as arbitrage funds and balanced advantage and aggressive hybrid funds would classify in this category. So a lot of investors are actually moving from the traditional debt fund towards more equity oriented schemes purely because of the tax difference that applies, as well as possibly from an asset allocation perspective. So today, see, as well as safety are the same in these newer categories. What are the other tax efficient alternatives that an investor can look at today? So to start off with, let's talk about the hunt for tax efficiency. So some of the options that are available are Provident Funds, the National Pension Scheme, tax-free bonds, arbitrage funds, and equity savings funds. So these are the categories that we're broadly going to cover today. So when it comes to Provident Funds, so those who are employed under an organization should have access to an employee provident fund. And the lock-in for this investment is until retirement. You can also increase your contribution to the EPF through something known as a voluntary provident fund. So your EPF is capped at 12% of your basic plus dearness allowance, and your employer will match your contribution. Your VPF, on the other hand, can go up to 100% of your basic and dearness allowance. Now, the rates on your EPF and VPF are fairly high. It's at 8.15%. And if you're self-employed or if you don't have access to an employee provident fund, your alternative is a PPF or a public provident fund, where the interest rate today is about 7.1%, and the lock-in is for 15 years, and you can extend your investment for a block of 5 years at a time. Now, the investment limit for a PPF account is roughly 1.5 lakhs per year. And in terms of taxation, this is an interesting 2.5 lakhs. Otherwise, this is tax-free. Now, on maturity, your EPF as well as your VPF proceeds are tax exempt. and you can withdraw your VPF after a period of 5 years, but it's an initial 5-year commitment. Now, moving on to the National Pension Scheme or the NPS. Here, this is a product that allows you to have a hybrid exposure, in the sense your allocation to equity debt can vary over a period of time. So this is a lock-in product. It's primarily meant for retirement. So your lock-in is until you turn age 60, and you can continue to stay invested in the NPS until you're 70 years old, after which you would have to withdraw your investments. Uh, from a performance perspective, NPS has done really well. You've seen a 9 to 11% CAGR on, or that is your compounded return on the top schemes. So NPS actually has two accounts. You have a tier 1 account where the maximum limit is capped at 50,000 rupees. But the tier 2 account does not have any limit, and you can continue to contribute as much as you would like towards the NPS. Now, upon maturity, you can take out 60% as a tax-free lump sum. So there's no tax on the 60% that you withdraw, but the balance 40%, or at least 40% of your corpus, needs to be commuted into a pension scheme. So this ensures that at the time of retirement, you have some steady inflow that comes in by way of pension, and you have a corpus that you can manage later on. So this is where the tax efficiency is. Of course, your pension as of today will be taxed at your like how salary is taxed at your slab rate, but the lump sum that you've accumulated until retirement is a tax-free withdrawal. Now, if you want to exit your NPS prematurely, or if you're looking at withdrawals for specific reasons, then the tier 1 account has specific conditions, meaning it should be related to your health or your child's education, or if you're spending on a wedding. So these are the primary reasons under which you can apply for an NPS withdrawal in the tier 1 account. On the tier 2 account, there is no restriction on what you need to withdraw the proceeds from for. So you can take it out for any reason. But the catch here is that if you prematurely exit the NPS, then more than 80% of the lump sum that you, or 80% of your corpus, needs to be converted into a pension, and you can only withdraw 20% as a taxable lump sum. But the biggest advantage of having the NPS is that you can modify your asset allocation over time. So if you feel like you want to follow a more aggressive approach, meaning higher allocation to equity on a particular year, or higher allocation to debt in a particular year, you can change up and switch up your asset allocation. And that's without any sort of tax liability in that case. So this allows your investments to compound until retirement, and you can adjust your asset allocation, or you can choose for an auto balancing strategy where you, according to your age and your life stage, the NPS itself has certain asset allocation plans. Now, our next investment is tax-free bonds, and this has been a popular choice amongst HNI investors for a long time. So in terms of who issues tax-free bonds, we primarily have PSUs that come up with tax-free issuances, but there are only a few bonds available in the market today, and there haven't been new issues for a very long time. So what is available in the market is with a maturity date between 2025 and 2034. And the current yields are somewhere between 5 to 5.1 or 5.2%. Which is a post-tax return, because whatever interest you earn on tax-free bonds is tax-free. If you exit these bonds earlier than the maturity date, then capital gains are applicable on the sale of these bonds. And since most of them are listed bonds, it would be 10% without indexation. And the other option, or the other alternative to a debt fund, because now there's a uniform taxation across fixed deposits, bonds, as well as debt funds, would be other bonds that are available, right? So your government securities today trade in the range of 7 to 7.25% in a 1 to 10 year maturity bucket. if you're looking at high quality PSU bonds that are rated AAA, then your returns are in the range of 7.5 to 7.6% across maturities. And if you're looking at bank or NBFC bonds, the returns are slightly or marginally higher at 7.7 to 7.9% across a 1 to 10-year horizon. Now, where we are today, the yield curve is pretty flat. So kind of looking at a 8 or 9% return from debt seems to be difficult without taking some level of credit risk. And we also know that our bank deposits today are coming at 7% and higher. So the alternatives as such, we think there is some merit in sort of waiting and looking at the yields spreading out or getting a better compensation. But selectively, you could get a good issue. So talking to an advisor or talking to somebody who's more in tune with the market and aware of available investment opportunities would be a good strategy in terms of looking at alternatives to your debt funds as well as your fixed deposits. Now, another popular choice of late has been the alternative investment fund or an AIF, because primarily, if you look at the post-tax return, because AIFs look at targeting, say, a 10%, somewhere between 9 to 12% XIRR. So the post-tax return on those kind of schemes seems to be much more attractive. But there are a few things that we need to consider in terms of suitability and safety as well as comfort, right? So your lock-in period for an AIF varies depending on when you enter and what the terms and conditions of that particular fund are. So typically, the reason why AIFs are able to achieve a higher yield is because of the lock-in. So there are no liquidity constraints that the fund has in terms of meeting redemption pressures. They are also more curated, so the fund manager would be able to take on a higher level of risk, negotiate better covenants in terms of debt. So you could have a fund that invests in securities with a particular credit rating, but the credit rating of the fund could actually be higher based on the covenants and negotiation that happens in the underlying schemes. So you do have a higher yield, you do have a more sophisticated product. These are all good advantages of an alternative investment fund. But at the same time, to do all of this, AIFs do charge a higher fee structure. So as an investor, there are a few questions that you need to address before looking at this as an alternative to a fixed income fund. And some of them are whether the lock-in aligns with your investment horizon, whether you're comfortable with the kind of credit risk in the underlying securities. So higher yield or higher returns in debt, we need to understand that there's a ceiling in terms of what you can earn. And for every additional 0.1, 0.2% return that you're earning, you're actually taking on a higher level of risk. So whether that's something that you are comfortable as an investor is something you need to address, right? And also think about fee structures, whether this is something that you would want to pay. And if you're looking at purely a higher risk fund or a higher return structure, you should look at other asset classes as well, whether equity makes sense in your case. If you have a similar investment horizon, I think it would make sense to take a more holistic view of what you require. And then I will pass this on to Roshan from now to talk about arbitrage funds.
Hi. So now that we've covered a bunch of bonds and AIFs, let's start talking about the mutual fund space, your alternatives in the mutual fund space. So first, let's look at arbitrage funds. So arbitrage funds use a different type of hybrid models, but they are classified under the hybrid fund category, but they use a slightly different model. So let's see how they work. So arbitrage funds buy and sell the same security in spot markets and also in futures markets, right? So this price differential that they get between the spot and the futures market is called an arbitrage opportunity. And this arbitrage opportunity can also happen in different exchanges. So for example, when you buy in BSE and sell in NSE, or when you buy in NSE and sell in BSE, this also might throw out an arbitrage opportunity for you, right? Also, other factors that can offer arbitrage opportunities are, corporate actions like stock buybacks, mergers and acquisitions. Basically, wherever there is a price differential that you can exploit, that is an arbitrage opportunity, right? Um, these funds generally carry lower risk since the buying and the selling happens at the depend on if the fund manager or the fund house can aggressively take advantage of the opportunities that are available, because the markets are quite quick to correct these sort of opportunities, right? So the taxation for arbitrage opportunities are, since arbitrage funds are also categorized, even though they come under hybrid, they are equity related instruments, right? So the short-term capital gains for arbitrage funds is taxed at 15% for these are for units held for less than 1 year. And if you hold them for more than 1 year, they're classified as long-term and they're taxed at 10%. You can move on to the next slide, sir. Right. So now let's look at InvITs. So InvITs are they are also known as infrastructure investment funds, right? And these instruments, for the most part, they work like mutual funds. So they're basically they are designed to pool in money from investors, and they invest in income generating assets, right? And they are also like divided into units, and these units are listed on the stock exchange. So you can buy and sell InvITs from the exchanges itself, right? And so the income from these funds, right? Since they're income generating assets, the income is then distributed to you as an investor through a dividend, right? So when it comes to liquidity, InvITs are relatively easy to liquidate, apart from apart from like really high value properties where you might run into some trouble, but relatively most of them are easy to liquidate. And when it comes to taxation, the short-term capital gains for InvIT again is taxed at 15%, and the long-term capital gains are taxed at 10%, similar to equity. But the difference is that for an infrastructure investment fund to be classified as long-term, you should have held it for more than 3 years, right? And they also play a factor. You can move on to the next. Yeah, we've covered arbitrage funds. You can. Yeah, okay. Now let's look at the performance for arbitrage funds, right? So when you look at the NAV chart, right, you see a consistent up move, right? So this is for a period of 7 years, from 2017 to 2023, and in this period we've covered multiple cycles and the COVID period as well, right? But when we take a look at the 1 year rolling returns of these arbitrage funds, right, which is okay, so basically a rolling return shows a year-over-year returns for the time period, right? So when we take a look at the 1 year rolling returns, we see that during the cycle for a large period of time, we've seen lax interest rates, right? So interest rates have been low. The returns have also decreased year over year, right? For arbitrage funds. But we've seen a slight uptick around the 2022 to 2023 mark, where we've seen interest rates move up a little bit. right? The annualized returns for these funds have been around an average of 6.2%. Next slide. A hybrid fund category, right? So these funds invest in both equity as well as fixed income, but the catch is that these funds can also invest in arbitrage opportunities, right? Because they are allowed to hedge their equity positions, right? So the mandated minimum for equity and equity related instruments, right, is 65%, and the mandated minimum for debt positions is 10%, right? But from what we've come across, we've studied a lot of these equity savings funds, and from what we've come across, they hold about 20 to 30% in equity, and then the rest is split between arbitrage and fixed income, right? So this product, when you compare this product to a debt fund, which is what we're doing right now, because we're looking at alternatives to debt funds, they do carry moderate risk, right? But one of the advantages is that, again, you are taxed as an equity fund, right? So 15% for short term and 10% for long term, right? And these, but one of the factors that we do need to consider is that these funds are quite expensive. So your range for expense ratios for these funds go from 1% to 2.5%. And the average expense ratio for all the funds in this category is around 1.8%. You can move to the performance. Yeah. So again, the NAV movement for equity savings funds have been relatively steady, apart from that bit in March 2020. That's when all asset classes dropped. But you can see, if you would compare the NAV movement to an equity fund, this would look much better, because your equity exposure is low here, right? But the rolling returns of these funds are still quite volatile, because you still have that 20 to 30% equity exposure, right? And that would affect your year-over-year performance, right? So the rolling returns are quite volatile, which is why equity savings funds are not suitable for short-term investments, at least for like 1 year investments, 1.5 year investments, where your equity portion, if you have a period of non-performance or if you have a period of underperformance, that would definitely take a toll on the returns that you generate. Yeah. Okay, so let's take a look at the equity outlook. So this is just to give you an idea on what we're thinking equity-wise, because we have covered hybrid products as well in this webinar. So, as we see rates increase, right, and they might not go up further a lot, but they will continue to stay at the higher end for the foreseeable future, at least for the next 1 year, right? So we expect the volatility in global markets to continue, right? So when you have equity volatility, and when you will have equity volatility and tight financial conditions, until we see like a meaningful drop in inflation in the advanced economies. So remember, the advanced economies have a mandate of 2% inflation, right? So we are still quite a long ways away from reaching that goal, right? And when we take a look at the domestic scenario, the domestic macros, we are in a pretty sweet spot. Like, the domestic macros look pretty good. Corporate balance sheets are strong, and our inflation is within the within the RBI's tolerance level, right? So even though it's in the higher end, it's nearer to 6% than to 4%, but we are still in a pretty good position. We are in a great position when you compare your like India's domestic macros to the advanced economies macros, right? So again, this is again reflected. There was a study by Bloomberg recently. I don't know how many of you saw this, but according to Bloomberg data, the chances of a recession in India is 0%, right? Whereas if you look at the UK and Germany, like the like the European area as such, so the UK has a 75% chance of a recession, and Germany has a 60% chance of recession, right? And and again, in the same study, they said the US has a 65% chance. And places like Saudi Arabia have like a 5% chance, right? So I don't exactly remember, but I think we are the 0% for India was the best out of that chart that I saw. Yeah. So despite us being in a really good position, macro-wise domestically, we still expect equities to remain range-bound in the near term, right? Because no matter how good your macros are, you still need capital flows, and capital flows are tight, right? And if advanced economies do go into a recession, then again, their business environment is not that conducive, right? So yeah, so we expect equities to remain range bound, but if you're looking at like a long-term perspective, then yeah, the next like this year and probably the next year would be a really good time to accumulate equities. Can go to the next slide, Sam. Yeah, okay. This is again, so okay, so this post-tax illustration is for the last year. So it's from 2022 to 2023. So these are not forward projections, these are trailing returns, right? So we've taken the arbitrage fund, the equity savings fund, and a low duration fund. So a low duration fund is generally the preferred, like a 1-year debt product type. So since we're taking 1-year returns, we've taken low duration, right? Equity savings, again, equity savings, I would like to reiterate, is not suitable as a 1-year product, but we've received a lot of queries about equity savings funds. So I just want to show that illustrated over here. So if you take arbitrage funds and equity savings funds, they are taxed at 10%, right? For investments 1 year and older. And low duration funds are taxed at your slab. So when we take a look at these returns, right, until the 15% tax bracket, your low duration fund has outperformed the arbitrage fund. And when you go above that, then you see the tax impact on your post-tax returns in the low duration fund, right? And equity savings, again, equity savings has underperformed both of them. But equity did have a bad year last year, and you can never tell with equity. Like 1 year might be really good, 1 year might be really bad. So why do you want to take that risk for a 1-year investment, right? And when you look, even when you look at the weightages, right, 20 to 30% is not a small amount, right? It might not put you in a negative zone, but it can significantly impact your returns when compared to other 1-year products in the fixed income space. You can move on to the next slide. Okay, again, many people think that, like fixed income is easy. I just, buy one thing and forget it, or I just buy the product with the highest YTM, right? But it is not so. So a lot of fixed income funds did not survive the when you look at the bank bond defaults like Yes Bank, LVB, PMC, all that, and also the DHFL and infrastructure leasing and financial services, right? So these two events. So again, from 2018 to let's say the early days of COVID, right? There were a lot of events in the debt space, and a lot of funds did not survive that. So again, you do have to be careful, and you do have to do your due diligence even when it comes to investing in a fixed income product, right? So as we all know, Franklin Templeton had to close 6 schemes due to liquidity issues, right? And again, regulation also has not been easy on the fixed income industry as a whole. So when you look at the MLD taxes which they've removed, and all of us know most recently there was the removal of the indexation benefits, right? So these continue to pose a challenge to the industry. But when it comes to fixed income, please do your due diligence, consult an advisor if you have one, and just be safe. Like, you can move on to the next slide. Yeah, so all these challenges, right? So how do you as a fixed income investor overcome these challenges? Firstly, you can start thinking, long term, right? Like think of your retirement corpus and think of asset allocation, right? So you would want to do a proper asset allocation plan when you near your retirement, right? So pick out a few themes and stick to those themes, right? So when you pick a few themes for for your retirement, right? Pick out themes that are versatile and stick to those themes when you build your asset allocation, right? So again, you can look at short-term themes, but they can be used tactically for specific goals. So we saw the low duration fund is suitable for a 1 year goal, right? So for a 1 or 2 year goal, you can pick out um, some themes which you can use tactically. And for 1 and 2 year goals, equity really is not an option, right? So you can do that. And and again, when you invest for retirement as a part of your asset allocation, right? Um, you must remember that these mutual funds compound, right? Because there is no payout that you get, and your taxes are payable only on redemption, right? So as you keep accumulating, your capital also keeps compounding. And when you withdraw the funds upon retirement, right, your tax liability would automatically come down depending on how much income you have, or some people will not have any interest income or anything post-retirement. So there is a good chance that you may not even have to pay any taxes upon redemption, right? So again, the key is to keep it relatively simple. I think that is it for our, yeah. So if you guys have any questions, please, you can put them in the chat box, and Sam and I will address.
So I think we already have our first question from Mr. Vishwanath Kumar. So he says that he's taking early retirement and wants to park about 50 lakhs in fixed income with a monthly requirement of 40,000, which is also a tax efficient approach that he wants to follow. He is currently an NRI, so his present tax rate is zero, as most of his investments are in capital assets like mutual funds and stocks. So when we look at this, if you're looking at a monthly income of 40,000 rupees, that comes close to 4.8 lakhs in a year, or 5 lakhs. If your corpus is at 50 lakhs, then what you're actually expecting is a 10% return, right, on your investment, or 9.6 if you want to look at a more precise number. Where we are today in the market, if you are looking at a 9.6% return, there aren't any safe options where you can look at this kind of yield. So somewhere either we need to take a more balanced approach where you fulfill the income requirement through a separate corpus, and you have a separate corpus that does the compounding, and see if you can overall achieve a 10% return on the whole portfolio. Alternatively, you would have to take on some level of risk if you're looking at a 9.5 to 10% return on the corpus. Given that this is retirement money, there needs to be some thought that goes into this process. So we would recommend working with a financial planner, taking an overall view of your assets, and then planning it. Additionally, since there is this layer of being an NRI and returning to India, then also looking at how that status change could affect your investments as well as your tax liabilities is an important thing to consider. So with respect to PPF, the 5-year extension is allowed every time your 5 years are complete. I don't think there is a I don't think it's only for one extension. I think you can do multiple extensions also. The question for that was in PPF, you have a 5-year extension after 15 years. How many extensions can we take? Is it only one? If we have anyone with questions on YouTube as well, please let us know. Our team will type it in here and we'd be happy to answer them. From Mrs. Subhashini and Ramakrishnan, from a taxation perspective, are InVITs the same as REITs? Yes, so I think in both cases, return of principal is not taxed, but the return of interest will be taxed at your marginal slab rate. Under the new products, which are most low risk investments available for conservative investors. So see, I think we'll just go back to the last slide because it depends completely on what kind of investor you are. So if you have been a pure FD investor, then there's no pressure for you to change out of that and come into a debt fund or a bond or anything else, because you can stay within your comfort zone. The only thing that I would point out is that if you're an RD investor, the RD rates are very low. The FD rates are at least competitive in comparison to debt funds as well as safe bonds, especially because there are a variety of banks offering different levels. Plus, you have corporate deposits also, which are coming at a slightly better yield than the bank deposit, right? So maybe for an FD investor moving from a bank deposit to a corporate deposit, again, under the guidance of an advisor, understanding what the underlying financial strength of the corporate that you're lending to is key. So that is one thing. But if you're looking at parking, say, emergency money, etc., debt funds are more tax efficient because only when you take out the money do you have to pay tax, right? So this, I think, would be the broad framework that we would use in helping investors map their savings to a particular product. The next question is, can we start looking at long-term state-backed PSU bonds, which yield around 9 to 10% with an intention to hold them till maturity? So yes, again, based on your specific profile, as well as if you see a state-backed PSU bond, like understand what the covenants are, right? Like, is it actually state guaranteed? Is it not guaranteed? Has there ever been a default in the past? These kind of things are important questions to answer when you're looking at a higher yield product, whether it is a PSU or a corporate bond or something in the AIF space as well. But ideally, the thing is, if you hold to maturity, you will realize a similar yield as to the time of investment. That's the key advantage, because broadly, the bond market is still kind of illiquid. So entry and exit takes time. So holding to maturity is the best way to approach it. So if you're not comfortable making the investment, it's a very binary decision, right? If you're not willing to hold to maturity, then think twice before making the investment. What are the differences between AIFs versus PMS? Is the asset class preference left to the portfolio manager totally in the case of AIF? So I think between AIF and PMS, so firstly, like there are many layers of differences. So your first layer would be your minimum ticket size, which in the case of a PMS is 50 lakhs, whereas in the case of an AIF is going to be 1 crore. Typically, I think there are 3 categories of AIF. So even within that, we'll be happy to share like a video that we've done in the past relating to this so that you can see what are the different categories and what are the rules that apply to them. Broadly, in terms of debt, AIFs, it tends to be a category 2 AIF. So there is a higher level of risk. There is a lock-in. Whereas mostly in PMSs, I don't like there'd be an exit load, but there isn't really like a lock-in per se. So this would be the primary difference. There have been a lot of equity PMSs, but I've not seen that many fixed income ones. So that's another probably difference. And in terms of whether it's totally the fund manager, the portfolio manager's discretion in maintaining and managing the AIF, I think that depends on what the fund prospectus actually says, right? So there will be certain covenants or clauses which say what the strategy of the fund is and what kind of asset allocation they can follow, because some of the category 2 debt AIFs have some equity exposure as well. Okay. Next question from Mr. Vishwanath is, can REITs and InvITs be considered for steady cash flow? I think in the past, we have seen some level of cash flow that comes in from these products because they are expected to distribute the income. But wherever there's a high distribution of cash flow, you need to realize that there won't be capital appreciation. So we need to study the product and understand whether it's likely to be able to distribute cash in the future also. And again, from the cash flow distribution, you need to see how much of it is going to be tax efficient for you. Target maturity funds, I think from the perspective, it depends on what you're going to allocate it to. Like, does it work for a particular goal? Is it aligned with certain things? Given today that the yield curve is very flat, meaning difference between your 1 year return, your 5 year return, and your 10 year return are not that much. You would need to see where you're getting the best yield and selectively invest in that category.
Also, if I could add on the InvIT question, right? The cash flow from these funds, they depend on the operating income of the fund. So if there is a scenario where the operating income of the fund is low, and yes, you were right, they do need to, distribute 90% of the fund's income as dividends, right? But what we need to keep in mind is that these returns are not, steady. It's not like a guaranteed percentage of return, like your savings bank or an FD or something like that, right? Or a bond even. So that is one more thing you need to keep in mind when you're looking at REITs and InvITs for cash flow purposes.
So, Roshan, do you want to take Mr. Vishwanath's question?
Yes. So we had to look at higher face value bonds. Again, the bond markets here are a little bit illiquid, so you won't have that many bonds trading in the open market. So you have to go through brokerage houses, and there are specific brokers who deal in bonds as well. So we have to go through them. If you are interested in looking at higher yielding bonds, you can get in touch with us, and we'll be able to help you with that.
Yes. So responding again to Mr. Vishwanath Kumar's question, I tried Googling but could not find. I'm looking at 1 crore face value because my friend wants to invest in them. I think, like Roshan mentioned, you can talk to your mutual fund distributor, you can talk to a broker. All of these people should have bonds. There are specific brokers for bonds who will be able to assist you. And it's better to sort of review and see. You may not find something with such a large face value which is liquid because typically the larger lot sizes are traded by institutional investors. So if you're looking at 10 lakhs, you'll have some retail participation, but if you're looking at 1 crore and above, that tends to be occupied more by institutional investors. So again, you'll have to be patient and sort of waiting for the buy purchase to happen. All right. To respond to Mrs. Subhashni and Mr. Ramakrishnan's question, considering that the interest rate has possibly peaked, what kind of debt funds are in the recommendation list of ithought.MFD for an investment horizon of 3 to 5 years between short-term, long-term, and dynamic bond? So I think fund-specific questions is something that you can talk to your point of contact at ithought.MFD with, because again, from a case to case basis, based on your goals as well as your risk profile and um, all of that, there will be some suitability analysis that goes into sharing this information with you and helping you go through with the transaction. Okay. All right. Question from Zia. Now bank FDs give 8 to 9% and some small finance banks also. So how effective and more attractive in investing are fixed income market products considering the current tax change? So we need to understand firstly that the regulation on small finance banks is very different from your typical bank as well as different from debt mutual funds. So if we look at in terms of regulation, I think mutual funds as well as scheduled commercial banks are very well regulated. And I think deposit insurance applies to a scheduled commercial bank, but may not apply to a small finance bank. And so this is something you need to consider. Not all small finance banks are the same. So reviewing the bank balance sheet, reviewing the corporate governance, as well as what the regulatory framework would be, is important before making an investment purely based on the return perspective and the tax efficiency. So on a safety parameter, we would say that it is lower for a small finance bank as opposed to a bank or a corporate FD. And uh, from a tax efficiency perspective, pretty much all are on the same parameter. So we still have a few more minutes to answer questions. So if there are more, please do type them in the chat box and we'll be happy to take them. Thank you, sir.
Thank you for attending, sir.
All right. I think people are dropping off. So, and there are no more questions. So, once again, thank you everyone for joining us today. If you have any questions on investments or products, please do reach out to your respective points of contact at iThought, and they can definitely help you taking this forward. And of course, these are our coordinates. So, if you want to get in touch with either Roshan or me directly, our details are here as well. Thank you once again. See you next time.
Thank you, everyone.